Dear students, I have come with new module, module 11. This is incidence of tax. Just like residential status, incidence of tax is an important concept in income tax. This will decide whether an income is taxable for a resident, not ordinarily resident, and non-resident. Deemed resident rules are totally different. So, incidence of tax we are considering only resident, not ordinarily resident, and non-resident. Because deemed resident, the rule is if the income is exceeding 15 lakhs or more, if it's not taxed in any other foreign country, and if he has stayed in India for 122 days in the current previous year, it will be taxed. So we don't have to mix that with the other three residential status. Now regarding this incidence of tax, I have divided into two parts. One is module 1. Here I will give you 6 rules to decide the incidence of tax. 6 rules are there. These are the basic principles. If you know these 6 rules, and then you will be able to do all the problems on incidence of tax. Just like residential status, incidence of tax is also an important concept in computing income, and it's a sure examination question. So we will go to the module. So part 1 of incidence of tax is module 11. Now the first rule is income received or deemed to be received in India. Income received, whether we are receiving any income, it will be in India, it will be taxable for all, resident, not ordinarily resident, and non-resident. That means it is immaterial whether it is earned in India or in a foreign country. When we do the problems, it will be more clear. This is rule 1. Now what is rule 2? Income earned in India, whether received, paid in India or outside India. This also will be taxable in all cases. Income received or income earned in India is taxable in all cases. Rule 3. This is an important rule. Income earned and received outside India from a business controlled or profession set up in India. How do you decide whether the business is controlled from India? You have to see that where is the head office of the business. If the head office is in India, in the case of a business or profession, it is an Indian income. So here, income may or may not be remitted to India. If they are doing business in a foreign country, they may not be sending that amount to India. Now what is the rule? Rule 3. So this is for resident and not ordinarily resident. This is taxable. Non-resident, it is not taxable. Rule 4. Income earned or received outside India from a business controlled or profession set up outside India. So the difference between third rule and fourth rule is based on where the head office is set up. So in the case of fourth rule, only for the resident it is taxable. Not ordinarily resident and non-resident, it is not taxable. That meaning if the head office of the business or profession is outside India. Rule 5. Income earned or received outside India from any other source other than point 3. Now point 3, what is the point 3? Business or profession controlled from India. How will you decide how it is controlled from India? You have to see where the head office is located. That meaning it can be income from agriculture from a foreign country, income, rental income, dividend income, royalty, anything it can be. So what is the rule? It will be taxable only for resident. It is not taxable for not ordinarily resident and non-resident. Sixth rule is very important. Income earned and received outside India in the years preceding the previous year in question, and if the same is remitted to India during the current previous year. Imagine a person living abroad for so many years. When they will come back to our motherland or India, then they may bring all their earnings. They have earned not in the current previous year, but they are bringing that money in the current previous year, but they earned in the previous years. That meaning resident, it is not taxable in all the cases. Resident, not ordinarily resident, and non-resident. This is rule 6. Now we will do one problem. When we will do the problem, it will be clear. So which of the following incomes are taxable when the residential status of Mr. A is resident, not ordinarily resident, and non-resident? So when you are doing the problems, I am very particular that I will always tell title should be there. Title should be there. Here this column will be particulars. Here resident, not ordinarily resident, and non-resident. Particulars, resident, not ordinarily resident, and non-resident. This is very important. So here We have to see the question. So first one, income earned in Canada but received in India. Income earned in Canada but received in India 2000. I am not writing that first point is, this is taxable income earned in Canada but received in India. Taxable in all cases. 2000, 2000 and 2000. Second question is 5,000 earned in Africa and received there but brought to India. So here also 5,000 earned in Africa. It's not mentioned that it's from business. So we are applying rule 5. Second question, it will be taxable for the resident, not taxable for not ordinarily resident and non-resident. This is rule 5. Third point is 5,000 earned in India but received in Canada. So here rule 1, 5,000 and 5,000. Now fourth question is 10,000 earned and received in Sri Lanka from a business controlled from India. So this is rule 3. Business controlled from India, meaning you have to remember it's rule 3. Income earned and received in Sri Lanka 10,000. That is the rule 3. 10,000 taxable. 10,000 taxable for not ordinarily resident and not taxable. This is the point 4. Now we are coming to point 5. Point 5 is house property income computed from Sri Lanka rupees 2,000. So 2,000 house property income. It's not business income. Then rule 5 will be applicable. Fifth point, rule 5 will be applicable. That is 2,000 house property income. If it's business income, rule 3 will be applicable. So here it will not be taxable. Now next question is, rupees 4,000 house property income from Sri Lanka computed. Now 4,000 was past untaxed foreign income which was brought to India in the relevant previous year. It will be rule 6, it will not be taxed, all cases. Past untaxed income. Now seventh point is profit earned from a business in Kanpur. That meaning it is business income received in India. Profit earned from a business in India, that is rule 3. This is taxable in all cases, 10,000. Now you have to remember total income. Total taxable income you have to calculate. Total taxable income. So here you will get the total 34,000. Here you will get 27,000. Here you will get 17,000. So this is how you calculate. Now you have to remember that sometimes when we will ask this question, students will write the rules whether it is taxable or not taxable. When you are asked to compute the taxable income with the values, you have to prove that. So it's very important, you have to do that. Some students will write just the rules, whether it is taxable or not, they will not get any marks. And usually we will divide the marks, each point, if it's a 10-mark question, we will give 7 points, 1 mark each. For the total also, values, marks will be assigned. So you have to be careful, total income also should be correct. Now, second problem, compute the gross total income of Mr. A for the assessment year 25-26 if he is a resident, not ordinarily resident and non-resident. Now, interest in German government securities, 1/3 received in India and 2/3 received in Germany. So here, when it's questioned like this, you have to remember see, first question, it's divided into 2. Received in India, received in Germany. Received in India and received in Germany. So you have to remember the value. Received in India 51,000. 1/3 is received in India. That is 17,000 received in India, taxable in all cases. From 51,000 minus 17,000, 34,000 you will get. That is the income received in Germany. It will be taxable only for the resident. So it's received in two countries, meaning you have to divide it into two. Now the second point you have to remember. Income from agriculture in Bangladesh remitted to India 31,000. So here you have to remember income from agriculture 31,000 will be taxable only for the resident. Other two cases it will not be taxable. Now the third point, income from property in Canada received in USA rupees 1,10,000. So here you have to remember income from property. This is rule 5. It's not business income received in other country. It will be taxable only for the resident. 1,10,000. 1,10,000. It will not be taxable for other two cases. Now the next point. Next point is income earned from business in Kuwait. Business being controlled from Mumbai. 25,000 received in India. Total amount is 65,000. Business income controlled from Mumbai. Mumbai meaning its head office is in India. That means it's an Indian income. So how will you calculate? 65,000. This also received in two countries. So 25,000 received in India will be taxable for all cases. All cases. Now balance amount 40,000 received in Kuwait. This will be taxable for only two cases. 40,000, 40,000. For non-resident, it will not be taxable. Now, next question is dividend from an Indian company 15,000. It will be taxable in all cases. You have to remember earlier up to 2019, dividend income was not taxable. Now it is taxable. 15,000, 15,000, 15,000. Taxable in all cases. Next question is royalty received in Singapore from Mr. D, a resident in India for technical services provided for a business carried on in Singapore. 25,000. So here the point is 25,000. 25,000. It's not for business income. So the rule 5 will be applicable. 25,000 will be taxable for the resident. Other two cases it will not be applicable. Since it's not business income, we will consider rule 5. Now profit from a business in Chennai. This business is controlled from Singapore. 1,25,000. That meaning you have to remember 1,25,000. Business from a business. Profit from a business in Chennai. Business in Chennai meaning Indian income 1,25,000 will be taxable for all cases. 1,25,000. Income from Chennai meaning head office will be in Chennai only. 1,25,000 will be taxable in all cases. Now, next question. Next you have to remember profit on sale of a building in India but received in Nepal 2,50,000. Profit on sale of a building in India. Profit on sale of a building in India. Profit on sale of a building in India. It is Indian income. 2,50,000 will be taxable in all cases. 2,50,000 will be taxable in all cases. Indian income. 2 lakh. Whether it's received in a foreign country or whether it's received in India is immaterial. Now the next question is income from agriculture in Punjab received in Mumbai 30,000. This is section 10, agricultural income from India is exempted. Next is profit from, so that is exempted in all cases. Exempted in all cases. Next is profit from a business in Indonesia. This business is controlled from Delhi. That meaning head office is in Delhi. 60% of the profit is deposited in a bank there and 40% is remitted to India. value is 40,000. See, in the basic rule of income tax is how much ever you receive, it is taxable. How you spend the amount is immaterial. So here, full 40,000 will be taxable. Profit from business, rule 3, 40,000 will be taxable for resident and not ordinarily resident. It is not taxable for non-resident. Now the next question is interest received from Mr. D, a non-resident, on the loan provided to him for a business in India, 28,000. So 28,000, rule 1, it will be taxable Indian income, 28,000. Now this is how you have to write all that and you have to calculate the taxable income. Total income you have to calculate, you will get 7,40,000 here, 7,40,000. Here you will get 5,40,000 and last column is 4,60,000. 4,60,000. So this is what I wanted to explain in modules 11. Now I will be doing some more problems in the next module. Happy learning. Thank you.